All right, let's talk about SmartFinancial, ticker SMBK. They just dropped their earnings and yeah, the stock jumped. But you got to ask, right? Was this just a one-off beat or is there something more going on under the hood? We're going to dig into their Q4 numbers and figure out exactly why this regional bank seems to be firing on all cylinders. Okay, so here's how we're going to break this down. First, we'll hit the big headline numbers. Then we'll dive into the quality of those earnings. We'll look at their strategy, what they're saying about the future, and then we'll give you our take, our rating on the stock. All right, Section 1, the headline beat. So Smart Financial reports after the bell on January 20th, and boom, the numbers hit the tape and immediately got everyone's attention. We're talking a clean beat on both revenue and earnings. So they posted GAAP earnings per share of 81 cents. Now, 81 cents might not sound like much, but it came in 3 cents ahead of what the street was looking for. And you know what's really great to see? There's no fluff here. No weird accounting, no one-time adjustments, just a clean, solid beat on the bottom line. That's what you want to see. Okay, let's look at the top line. Revenue. That came in strong at $53.31 million. And again, why does this matter? Well, it beat expectations by almost $2 million. Look, that's not just a rounding error, right? That tells you there's real strength in their actual day-to-day business. So did the market care? Oh yeah. The stock popped right at the open, closing up about 3.5%. And here's the key detail. It was on higher than normal volume. That's your signal right there. It tells you there's real money, real conviction moving into the name. This wasn't just retail traders. But listen, a headline beat is one thing. The real question is how they did it. And this is where it gets interesting, because management was really hammering home the idea that this wasn't some fluke. This was a high-quality quarter. Yeah, the CEO, Billy Carroll, he came out swinging. He basically called this the grand finale to the best year in the company's history. And he kept using one word over and over: execution. And you know what? He brought the receipts to prove it. And this table, man, this says it all. You can just see the quality here. It's not one single thing, it's everything. Net income, up huge. Net interest margin, the bank's core profit spread, expanding. They're growing loans, they're growing deposits, and look at that tangible book value up 17% year over year. Folks, that is what a healthy bank's report card looks like. So you can really boil this whole story down to 3 things. 1, their core profitability is just on fire. 2, they're seeing real organic growth, $141 million in new loans. They're not just buying another bank to get bigger. And 3, and this is so important right now, they're getting their funding costs down. You put those 3 things together, that's a powerful combination. So what's their secret? Well, honestly, there is no secret. What Smart Financial is doing is straight out of the classic regional bank playbook. It's the strategy that every single one of their competitors is trying to pull off, but very few are actually getting it right. And what is that playbook exactly? Well, right now for banks, it's all about growing your core loans and deposits while at the same time aggressively managing what you pay for that money. The goal is to widen that net interest margin. Sounds simple, right? But believe me, in this environment, it is anything but easy to actually do. And here's the proof. This is basically their report card. Did they grow loans? Yup, check, 13%. How about deposits? Check, 8%. Did they lower their funding costs? Big check. I mean, they're just ticking every single box. 7. That's the number to remember. This is their 7th quarter in a row of positive operating leverage. Now, what does that mean? It's simple. Their income is growing way faster than their expenses. That's the holy grail, right? It shows this isn't a fluke. It's a sustainable, well-oiled machine. Okay, let's talk about the future. What did management have to say? Well, their tone on the call was, let's just say, very confident. They weren't just talking about keeping things going. They were hinting at hitting the accelerator in 2026. So they didn't give strict formal guidance. Instead, the CEO did something I think is way more interesting. He threw down a gauntlet for his own team. He set a challenge goal to hit a $4 EPS run rate by the end of 26. You do the math? That's $1 a share in Q4. A massive jump from where they are now. That's a bold target to put out there. And the Q&A session with the analysts, it really just doubled down on that confidence. They're talking more loan growth. They see that all-important net interest margin getting even wider, and they're going to stay disciplined on expenses. But you know what really stood out to me? Their focus is purely organic. No big, risky M&A deals. They want to build this thing brick by brick, not just buy their way to growth. That's a great sign.
Okay, so that brings us to the big finish, the next call. After a quarter this good and a stock pop to match, what do you do now? Where does it go from here?
And that's the million-dollar question, isn't it? I mean, the stock already jumped 3.5%. Did we miss the boat? You might think the easy money's gone, but when you really look at the fundamentals, I think this story has a lot more room to run.
So, with all that in mind, we're initiating coverage here with an outperform rating. It's pretty simple, really. This company is doing exactly what it says it's going to do. In a tough sector, they're showing best-in-class execution on all the metrics that actually count. We think there's a clear path higher from here. We're setting our price target at $44. How do we get there? Well, as they keep expanding that margin and growing their book value, we believe the market is going to keep rewarding them for this kind of quality execution. It's a compounding story. All right, that's our take. But remember, you have to do your own research. This is not financial advice.